This is Agriculture Today. I'm Samantha Bennett with the K-State Radio Network. Ahead of us this Wednesday, we start with K-State and Washburn University School of Law's Roger McEowen. He joins us to discuss the recently announced student loan forgiveness plan outlined by the White House and why he believes this will be the first true test of the ruling by the Supreme Court on the West Virginia versus the EPA case, which was considered a big win for agriculture. Also ahead, Jenny Ifft, K-State Agricultural Policy Extension Specialist, discusses margin protection insurance in its entirety. She covers how it differs from other crop insurance plans and who should consider this form of insurance. We end with this week's edition of the Beef Cattle Institute's Ask the Experts, where K-State experts Brad White, Phillip Lancaster, and Bruno Pedreira answer a listener's question on how to make the most of Bermudagrass that was treated with nitrogen this past spring. That and more awaits us ahead on Agriculture Today. This is Agriculture Today. We are back now for our agricultural law segment, which as always is covered by Roger McEowen. He is a K-State and Washburn University School of Law professor. So Roger, thanks for joining us.
Good to be with you, Samantha.
Absolutely. We're happy to have you here as well. And today we're covering a story that listeners might hear and they're like, well, what does this have to do with agriculture? But we'll tie it all back in towards the end. But it's the latest information that's been released from the administration on forgiving student loans in the country. So tell us a little bit of background on this and what we should expect.
Yeah, that's right. As just about everybody has heard, the administration has announced that it would cancel or will be canceling up to about $20,000 in student debt for Pell Grant recipients and up to $10,000 in student loans for those that make under $125,000 a year. Now, that's double that amount for a married filing joint return. The cost of this is projected to be in excess of $300 billion.
Wow. Yeah, when you hear that 300 billion number, it's hard for me to even grasp how much money that actually is. And the question really is now is this constitutional, right? Because this case will be really the first testing the Supreme Court's ruling on that ruling West Virginia versus the EPA that we covered not too long ago. Is that correct?
Yeah, that's how I read the administration here is using a post-9/11 law, the Higher Education Relief Opportunities for Students Act, or HEROES Act, to justify what they're doing. And that act gave the Education Secretary authority to waive rules related to student financial aid programs when there's a war or national emergency. And so what the administration is saying here is because COVID was declared a national emergency, the administration claims that forgiveness of student debt allows the borrowers to not be placed in a worse position financially as a result of the COVID emergency.
I guess that's my question here is when it comes to declaring a national emergency, do they have a fine start and stop date, or is it just something that kind of dissipates like we've seen with COVID over time?
Yeah, well, 22 is a lot different than August of 2020 when it comes to COVID.
Absolutely.
Is COVID still a national emergency now that justifies the action? I would say that it's pretty clear that no, August of 2022 is nowhere near the situation of August of 2020. I think it's really a big stretch to suggest that the world of COVID in August of 2022 is anything like the world of post 9/11 that they're basing their power on because of the HEROES Act that was enacted because of that. And even if it is an emergency, the question is whether, even if it is an emergency, is that enough? Post the SCOTUS opinion of late June in West Virginia against EPA, as you referenced, I'm not convinced that it is. It may fit the text of the statute, but now the Supreme Court has said that's only the first step. You have to clear what's known now as this major questions hurdle.
Just to recap back on that West Virginia versus EPA case, that was considered a huge win for agriculture, right? Because it helped kind of put control on a lot of those regulatory agencies, and that not only attests to those certain circumstances, but also in the circumstances that we're seeing now play out, correct?
Put it this way, agriculture is very heavily regulated at both the federal as well as the state level. And in that West Virginia against EPA opinion, the Supreme Court really curtailed the EPA's authority to regulate greenhouse gas emissions at coal-fired plants without express congressional authority under what's known as the Major Questions Doctrine. They have to have a specific grant of authority if you're going to really change the manner in which energy is produced in this country by regulation. They said, no, that requires Congress to clearly delineate in statute how you go about doing that. So what that tells me is that congressional authority is now necessary before the executive branch and the agencies of the executive branch take major actions that will have large economic and political significance. And a $300 billion price tag certainly is large economic significance, I would think, under that West Virginia EPA case. And as you said, that was a huge, what we agriculture, a big win for agriculture on issues such as wetlands, what the WOTUS rule is, and anytime you have other conflicts with federal government regulatory agencies that are basically are policies being implemented at the agency level rather than being set by the Congress.
Oh, you've mentioned before the doctrine being really questioned at this point.
Yeah, clearly the Congress can do what the administration has done here. I don't think there's any question that the Congress can do it. They can pass it. The question is whether the executive branch can do it without the Congress, and that's where the rub is. And the administration's already lost cases where it claimed to have emergency power. You think about their attempts to get a vaccine mandate, the tenant eviction moratorium. Both of those were struck down by the court, saying you don't have the power to do this unilaterally. So the question is whether they can, again, is this a legislative function or is it a regulatory function by the executive branch? Now, before this can be challenged, a lawsuit can only be brought if the party bringing the suit can prove that they have been harmed. That's known as standing. So who has standing in this instance? Well, the Obamacare saga teaches us that the U.S. House of Representatives would in this instance, but as currently constituted, they're not going to bring a suit, only if it politically changes hands this fall, and then we have to wait until a new Congress is seated in January before they would be able to bring a suit. Well, if you want to move quicker than that, private banks or loan servicers that have a direct or indirect relationship to the loans would have standing because they have harm. So once you clear that hurdle, and I think you can clear that hurdle in this instance, there's a debate, granted, there's a debate among legals, but I think the weight of the authority is on the side that there would be standing in those two parties.
Absolutely. And you mentioned the timeline of both of those. So it's either private bank comes forward sometime soon or relatively soon in the grand scheme of things, or we find out after our latest election season and into the new year. But even if that changeover happens and there is standing that is occurring, it's going to be a long timeline for this to actually be figured out. Is that correct?
Yeah, I've gotten this question already, and that is, okay, so what happens if a lawsuit's filed? And, well, nothing can happen until the administration finalizes the policy. You can't just make an announcement and then the next day apply for loan forgiveness. No, there has to be a process where the administration would finalize the policy. Then once that happens, a court could be asked to issue an injunction, and I could see some banks that have standing asking a court to, hey, wait a minute, let's stop this till the courts settle the constitutional issue that's involved. And that would force the administration to either extend its current repayment pause or have borrowers start repaying loans that might later then be canceled. And all of this might actually cause the administration to more fully explain how COVID fits the purpose of the HEROES Act and better detail the legislative history of the statute to justify their current plan, or try to fit, as an alternative, they could try to fit it under the Higher Education Act of 1965. Really, I think that's where this fits, because that's really the real reason for the action, purportedly to expand access to higher education.
I think the key that a lot of people are forgetting about at this point is that debt forgiveness is normally taxable, correct?
Sure is, yeah. It's canceled unless it's credit card debt or student loan debt, except for this. Normally it's taxable, but this would not be taxable under a provision enacted last year in the American Recovery Plan Act, as long as it occurs before 2026. So through 2025, this debt would not be taxable at the federal level. And that's not the case in all the states, because not all of the states couple with the feds on tax policy. They don't adopt the Internal Revenue Code wholesale. And so it would be taxable, according to my count, in 13 states. Kansas is not one of those states, but it would be taxable in 13 states. And so normally debt cancellation is taxable. Even if you're a farmer and you file Chapter 12 bankruptcy and you have some of your debt written down, forgiven, canceled, that's taxable. Now in a Chapter 12, what we can do is we can move IRS to the back of the line. We can deprioritize those taxes. But the normal rule is that, yes, forgiven debt is taxable.
And because this debt isn't, however, is that some added cost that we should anticipate because of this forgiveness plan?
Well, the forgiveness of the indebtedness on these student loans would add another $34 billion in lost tax revenue. So you've got the upfront cost of forgiving the loan, over $300 billion. Then you throw in another $34 billion in lost tax revenue, and you put those together. And I think that goes back to our major questions issue. This is a major policy change. It has tremendous impact on the Treasury, and probably, in my view, and there are arguments to the contrary, but I think those are the weaker arguments. I think this, according to the way the court has read the major questions doctrine, I think this would trigger it, and ultimately, I think the court, as currently constituted, would strike this administrative action down.
Wow. Well, Roger, as always, I will link to your blog in the show notes of today's program. So that way, once you have this article up and ready to go for listeners, if they're looking for more information, they can go and click and look at that. But Roger, as always, thank you so much for your time today.
Thank you, Samantha.
Absolutely. Once again, that was Roger McEowen. He is a K-State and Washburn University School of Law professor, providing our latest agricultural law update. Still ahead of us on today's program, we have K-State Agricultural Policy Extension Specialist, Jenny Ifft. She provides insight on margin protection insurance. Also ahead, we have Brad White, Phillip Lancaster, and Bruno Pedreira for this week's Beef Cattle Institute's Ask the Experts. We'll be back with that and more ahead on Agriculture Today. This is Agriculture Today. We are back now with Jenny Ifft. She is the Flinchbaugh Agricultural Policy Chair and also an Ag Policy Extension Specialist here at K-State. So, Jenny, thanks for joining us.
Good to be here.
So, today we're going to be talking about margin insurance. It's maybe something that's a little unfamiliar for most producers, but something you wanted to clarify and talk about. It's got an upcoming deadline, so we're going to cover that today.
Yeah, I'm here to talk about margin protection insurance. It's a part of the federal crop insurance program. The guarantee for this is based on a measure of a producer's operating profits. There's a September 30th deadline. The reason that we're looking at this, two reasons. One is just because there's been so much of inflation in the farm economy and the general economy. Everyone's dealing with it. On the other hand, we have pretty high commodity prices. Recently, we've seen corn go over $6, and the estimated guaranteed margin for margin protection insurance for 2023 is as high as it's been since 2018.
Wow. Well, good to know. Good starting basis for our conversation. What does this insurance really do for those that decide to partake in it?
So, margin protection insurance, it is a new product, and I'd say there's a fairly big learning curve for it. How I like to do is start with the original crop insurance product, which is yield insurance. So, you get a payment when you have a yield loss bigger than a certain level. But since then, now almost everybody uses revenue protection. That's a very standard practice where losses can be triggered by both price declines or yield declines. We also have the harvest price option. So if you have a sufficiently large yield loss, that can be paid out based on current prices. This can be really helpful for producers that are experiencing droughts. Mm-hmm. So now we have something called margin protection insurance. And again, this is based upon a measure of a producer's profit margin, or you could think of it like an operating margin. And so, again, there's yield. This is an area product, so that guarantee is going to be based on county yield. Also national prices, and the deadline is September 30th. Price discovery is happening right now, so it's based on August and September futures prices for the 23 crop.
Right.
So that's a big difference, but you take that yield and that price, and that measure of revenue is very similar to revenue protection. But what you're going to be subtracting from it is a measure of your input costs. Now, because this is an insurance product, the when they create the product, they have to be able to predict prices. That means you have to use futures markets. So the prices that really matter for this product that can actually be insured against are based on futures markets. So what you have is you have components of fertilizer that are sold in futures markets, so urea, DAP, others. You also have diesel, and interest costs are also taken into account. That's in short-term interest rates specifically based on futures markets. I do like to point out this is based on the raw materials, not the farm gate price, not the retail price. So those that guarantee is going to be based on what's happening in the futures markets. And we know that can look quite different, especially when everything is shifting.
Sure. Who really uses it? What is the best ideal person for this insurance type?
Well, I do want to be transparent. Not a lot of people have used it so far. In 2022, for the 2022 crop year, we had less than 15,000 acres of corn and soybeans combined in Kansas covered by this product, mostly in the Northeast, out of millions of acres insured across the whole state.
Right.
There's a couple reasons for that. The product did pay out for some producers using high coverage levels in 2018, 2019, and 2020 based on yield losses. So it has covered some losses, but really there's two things I think that are probably slowing down adoption. First of all, it is a new product and there's more moving parts. So it's not just your crop prices and your yields, it's also input prices that can trigger a loss. It's also a high coverage policy. Now, I've been on this program before to talk about the supplemental coverage option, SCO, and ECO, enhanced coverage option. And margin protection in practice works a lot like these policies, and there's an entire different set of considerations for using these policies on top of the standard revenue protection policies. First of all, just to point out why we should think of this like a high coverage policy. So you can get about 75% to 90% coverage, and that 75% is going to look similar to a revenue policy, but it's at the area level. Mm-hmm. But what a lot of farms opt to do, they like to have the underlying revenue protection coverage. So you can have it on top of a revenue protection policy. But that's going to give you your farm level yield guarantee. It's not going to be based on the county. It's more individualized. Also, the cost share is typically going to be higher. So the premium subsidy is higher. It's a better value. So you can put margin protection on top of that. Again, with any high coverage policy, there are a couple considerations. First of all, they cost a lot more money. If you're looking at a 95% revenue guarantee, it's going to cost a lot more. Your premiums could go up 3 or 4 times. With all the other costs that producers are facing, that's going to be a difficult decision. There is something you're paying for. You're paying out for larger payments that happen more often. Mm-hmm. So that's a real trade-off there. That's how it's designed to work. But in terms of the timing of those payments, it's certainly not guaranteed every year. You can go a couple years without a payment. It should even out over time. That's the typical experience. These products are designed so the producer comes out ahead. Again, that's not everyone's experience. But because of this is a different way of managing risk. It's a different perspective. It's not a casual decision, something that takes some time and study, a lot of work with your insurance agent.
Absolutely. And you mentioned the kind of coverage options. Is that the only thing that goes into it? Is you can do this separately and on its own completely, or it can be added on to already established RPs?
Yeah, so you could just buy margin protection and not buy revenue protection. Hardly anybody does that because of the good value that underlying revenue protection policy provides. So I do think from a bigger picture perspective, some producers might want to take that option, but for most, they'd be looking at it as a high coverage policy.
You mentioned that this isn't something that should be taken lightly. So this should be a conversation that's had with your crop insurance agent. What should some of those first conversations really include? What are some of the major talking points?
So I think a big part of it is that you want to be comfortable with high coverage and area protection. So you're going to be thinking, what are my yields? What are the county yields? How have county yields performed historically relative to my own yields? That's a conversation. The other thing I want to go back, I talked to $6 corn before. Mm-hmm. The margin protection guarantee is as high as it's been since 2018, despite higher expenses. So if there's producers out there who are looking to sell some of their 2023 crop, they might want to give this product a second look if they haven't thought about it before. I did say it's expensive. You're going to be paying a lot more, but if you look at the buying a put on December 23 corn, those costs are going to be pretty similar. Margin protection would be a better value than that. That's how it's designed. So that's an important consideration. I also think, how it covers input costs is an another important consideration to have. So like I said, the inputs that are measured in here are based on the raw materials sold in futures markets. The price discovery for that is in April. So for a 2023 policy, it's going to be in April of 23. And I know producers do a lot of things to manage costs. Prepaying inputs is a strategy that's used by a lot of people. So I think it's going to be rare that it exactly matches an individual producer's strategy to manage costs. It might be a complement for some people. I do think it could capture general inflation in the economy. If you think of crop year 2022 policies, they had price discovery in April when things had really skyrocketed. You think about diesel, urea, and others. So those had gone up quite a bit. And that was captured for 23 policies, which aren't finalized yet. So it will pick up on that. But maybe the bigger point here is that payouts for margin protection are going to be much more sensitive to price and yield changes than input cost changes. And part of that, the indemnity is only triggered by a portion of input cost changes based on those raw materials. But part of it's just that prices and yields have a bigger impact on your profit margin. So that's why you see the high cost for this product that it's covering.
Sure. So is this something that you'd want to invest in for a long haul type of scenario? You wouldn't want to just do it for a year and see how it goes. It's something you would kind of want to continue on.
I think a long-term perspective, when you think about, that's how I'd put it. If you want to use this policy, you can use a long-term perspective. Mm-hmm. If it's something you want to try out, there are ways to manage that. You could do it for a smaller number of acres. You could use a lower protection factor. So there's something called a protection factor. It scales up or down your premiums and your indemnities. So it is something you could try out, or you can think, okay, I want to use this, to capture these currently high margins. But all of those are best thought about from a long-term perspective, especially understanding how those indemnities work.
Absolutely. And I know you're planning on releasing an article outlining all of this, so maybe a bit easier for producers to read through and then reference back to as they have conversations with their crop insurance agents. Mm-hmm. When can they expect to see that?
So we'll put something out on agmanager.info in the next couple of days, and it'll go out on the Monday newsletter. Something, if producers aren't already signed up for it, they can sign up for an agmanager.info. We'll talk about some of the main characteristics and key things that producers should be aware of. We're currently in the price discovery period, so none of the margin isn't finalized for futures markets for the corn and soybean prices. They're still in price discovery right now. That's not going to be done till September 15th, so we won't know the final margin and the final cost until that time. Now would be the time to start talking to an insurance agent about that.
Sure. So a quick turnaround between that price discovery cutoff and then the deadline for applying for this.
Yep, there's 2 weeks.
Yeah, so something to, like you said, be proactive about and talk about now before those deadlines approach. But Jenny, as always, thank you so much for your time.
My pleasure.
Absolutely. Once again, that was Jenny Ifft. She is the Flinchbaugh Agricultural Policy Chair and our Ag Policy Extension Specialist here at K-State. We'll be back with more ahead on Agriculture Today. This is Agriculture Today. To conclude today's programming, we're ending, as we always do, with the Beef Cattle Institute's Ask the Expert segment. This week, Brad White, Phillip Lancaster, and Bruno Pedreira answer a listener's question regarding Bermudagrass that was treated with nitrogen this spring and then didn't perform as well as they had hoped due to the lack of precipitation this year. The experts lend their advice on how to make the most of it.
Hi, welcome to the Beef Cattle Institute's Ask the Experts, where our experts answer your questions. I'm Brad White, and with me today is Dr. Phillip Lancaster, nutritionist at the Beef Cattle Institute.
Hi, Brad.
And Dr. Bruno Pedreira, who is Ag Extension Agronomist.
Hey, Brad.
We find the right experts to answer your beef production questions. If you'd like to ask a question, send us an email at bci@ksu.edu with BCI Ask the Experts in the subject line. Our format is I'll ask each expert the same listener question, and they will have a chance to provide input, then respond to each other's comments. Each response will receive points with a maximum of 10 points available. So let's get started with today's question. Today's question is from a listener who had Bermudagrass that they put nitrogen on this spring. However, they did not get rain. So the grass didn't grow as well. And the question is related to how can I preserve that nitrogen, potassium, and phosphorus in the field as best I can? And they wanted to know whether they should chop it and let it go or if they should graze it. Dr. Bruno, we'll go to you first.
Okay, chop and leave it, it's an option, but thinking about making value out of our pastures, maybe grazing would be a better situation in this case, so he can make some money out of this field that he was not able to harvest anyway. Regarding the nitrogen, it will not be there anyway. It's hard to keep nitrogen on the soil. It will be there somewhere in the organic matter. Some will be in the system, but we cannot rely on it to be able to, for example, in the next year, do not apply any nitrogen. And yes, he's right. P&K will be there. They move a little bit more slow through the soil, and they can be there for him next year.
Excellent. That was a great answer for that question. And there's an 8-point answer, Phillip, to you.
Oh, man. So I think there's two things to think about. The nitrogen in the soil, you're probably going to have to reapply it next year anyway. And then getting some value off of that pasture this year. You didn't graze it any so far because it didn't grow very well. You might want to go ahead and graze it and get some value off of it. And every time you turn that nitrogen over through the system, from the soil to the plant to the animal back to the soil and the feces, you're going to lose more of that nitrogen through that cycle. And so I don't think there's a good way to retain that nitrogen in the system.
Excellent. Great answer there, Phillip. And I think as a follow-up question, you guys talked about potentially grazing that and how do I get the value back out? And Dr. Bruno, you mentioned he's going to have to fertilize that again this year. Are there any other options to maybe take advantage of either that nitrogen or any other thing that he can do to help in this situation?
Well, one situation that he could consider is to introduce any kind of legume or some of our winter cool season plants, and maybe be able to produce any other forage during the winter. And next year he will be back. If he decides to use any kind of legume, he may be able to add some nitrogen over it. So some clover or something like this may be helpful to improve some nitrogen into the system.
Excellent. Phillip?
Yeah, that might be a good way. He would need to graze that cool season forage, and that would give him some feed value for the winter that maybe he could capture that nitrogen this fall without losing so much of it through the wet season in the winter and spring.
Excellent. Both great answers to this question. And this is certainly a challenge because at the time we put fertilizer on, we don't know exactly what the weather's going to be. And this was a case where the weather did not cooperate exactly with what we want. But you guys are saying really no way to save that. In this situation, we're in a salvage mode. So what do we do and how do we manage it different? I like the potential addition of the legumes because that may add some nitrogen long term. But we also have to think about those other nutrients in the soil. So thanks for this great question, and we were able to have a good agronomist on with us. Thanks, Dr. Bruno, for joining us, and thank you for listening in. If you'd like to hear more from our experts, you can join us on our weekly BCI Cattle Chat podcast. And remember, to get your question answered, you can send us an email at bci@ksu.edu with BCI Ask the Experts in the subject line.
Once again, that was K-State's Brad White, Phillip Lancaster, and Bruno Pedreira for this week's Beef Cattle Institute's Ask the Experts. We'll be back with more tomorrow on Agriculture Today.